Welcome to Impact Investing. I'm your host, Jeffery J.P. Potvin. Today, we are honored to have Olga Duka, General Partner at Improv Ventures, joining us from Vilnius, Lithuania. Olga is a dynamic entrepreneur and venture capitalist with an extraordinary global footprint. With her experience across 10 plus industries and 3 continents, she brings a unique perspective to impact investing. As the managing partner at Improv Ventures M&A and GP at Point Improv Secondaries, Olga specializes in discovering and supporting exceptional entrepreneurs, talent in emerging markets like Africa, Latin America, and Southeast Asia. Her professional journey spans institutional asset management, startup development, and deep commitment to finding innovation solutions that empower human potential. With a background from Moscow State University and track record of building venture that creates meaningful change, Olga represents a new generation of investors who see beyond traditional financial returns. Olga, welcome to the show.
Thank you. Always happy to see you again, Jeffrey.
Likewise, it's always exciting to have you back. The first, maybe that's how we'll start. Is we'll jump in and just kind of share a little bit about from the first time we had the opportunity to interview yourself. It was in show 107, and some of the insights were kind of just how you had moved around the world in the different types of companies that you were seeing, and your, you know, I would say unique perspective of how you were investing and looking at early stage companies and where you took your background to find those hidden gems. And I think he'll be able to go back into the last show to kind of figure out what that sounded like, what it looked like. And a lot of it was based off that emerging market. And today you've kind of continued to grow in that path, which is very exciting. And I think that's where we're going to kind of jump into on this side. But before we do, as we normally like to kick our show off with one thing unique about you that no one would know. And then maybe you can just do a quick snapshot of, say, the last little bit of the career. And then we can jump into some hard hitting questions that we have for you today.
Yeah, sure. Something unique not many people know about me. I think actually a lot. I mean, I have multiple different passions and hobbies. I really see all things I do as like different forms of engagements of being myself. So for all the purpose, let's say I write poetry.
That's amazing. Not too
I
many people
sent
have a
I
skill that
sent
can
you
do
I
that.
sent you some before. You've
Yes, that
seen
is
it.
true. That is true. But it's amazing for the audience to hear that, we have all these different types of passions, things that we're good at, things that maybe we're not even good at, but we just enjoy doing them. And that's really what makes life unique and fun. And that you're able to focus on that. Is there a form of poetry that you like to focus on or utilize when you're being creative?
Actually, I see this art and work in my mind computes very, very well. So in poetry, generally, I'm still discovering my style, but it seems that I prefer more or less fluid and complex rhyme, like jazz rhyme poetry style. But like train of thought kind of poetry style as well, meta poetry, like cross connected with comments within itself and so on. But the thing is, every time I work on poems, I get a different perspective from business. As in, you constantly watch how like you shape your thoughts in an art form, and when you apply the same vision to business, a lot of things become actually much easier, I think. And you see not just high level strategy, you also see beauty, ethics. I mean, it's like some kind of mathematics and arts mix to me. And the same in business. Every time I work on business, or doing something practical, I keep thinking about, oh, I can maybe try this style in poetry, and it becomes this, customer development sort of thing, like product development, And so all the different ideas and thoughts from the business go into poetry on like some meta level, I guess, and the whole like connectedness and high level perspective from art comes back to work. So it's kind of enriching each other really, really well. Does it make
I,
sense?
It does. I think that's a great way to look at when you're focusing on building business or acquiring companies or um, anything that's kind of structured. If you look at what you're doing with um, poetry, is you're adding in this element of creativity. And if you take a step back and start to, the analogy I would say is a sports person. If I'm a hockey player, I focus on hockey day in and day out. And I go to the gym because the gym is apparently for strength. And I may run because I'm forced to run to have some cardio. But if you start to really dive into how you see the play and how you analyze things, it's starting to become more. You're basically have to be multifaceted because this is going to allow you to become more efficient at what you do on how you see the plays. So, as an example, my strength might be great from doing weights, but maybe if I threw in yoga, that would strengthen other parts of my body that would allow me to move a little bit quicker or faster or react quicker. And if I focus my mind in a little bit differently, and maybe that's on mapping or data mapping, maybe if I analyze data a little bit differently, then I start to see the ice differently and I can react quicker. Or if I, enhance these other skills, will that pick my game up individually overall to make me more superior than the players that I'm competing against? So if you take that same analogy to what you're doing, is that you're utilizing this creativity to bring in a different aspect of how you see a business and using that to kind of surround the outcome that you're going after and saying, look, if I bring this other layer of creativity, I can start to see things that others won't see. I'll start to be able to add in this element of where I'm going to and what other things can I bring into this game to make it a stronger play. So I think it's amazing. The more things you can bring into the game are going to make you that much better.
The element of surprise. There,
100%.
there is another thing, by the way, which I find quite fascinating. So, in all of my experience of working with artists and like being like writing poems myself, being a photographer, by the way, as well, is you're kind of working with something bigger than you are, and you're connecting to something completely outside of your area of control, area of knowledge. Like the language is a river which you step into when you're writing. And it's a big difference to the way we usually manipulate words in business, right? But the whole idea of stepping into something which, like, you should allow it to move you to actually be good in it, it kind of correlates to businesses which are worth building, in my view. Because, first of all, there are not that many areas of control generally in life, and once you succumb to this, it becomes much easier to have good decision making process. But also you start paying attention to all the different ideas which are bigger than you are, than like a whole team of founders, you know? And this whole ability to see things, ideas worth doing, which are bigger than the team combined, become a very, very natural thing to do, because you always get into the language and you feel exactly the same thing.
Now that's well shared because I think your mind is working towards a focus, and typically it's linear. Everything has to be done in a certain way. And I think if you bring in these other elements, the creativity side, and you allow yourself to be challenged, you then become more open and fluid with other pieces that can be tied into that overall structure. And I think that's what allows the creativity to work, because probably most people are afraid of the creativity side or afraid of how that can influence the direction of where you're trying to go. And you could say, this is purely finance. I can't focus on the creative side. But if you had a creative way, you might alter the way you're doing finance. Or if you have creative risk, you may change how that product will be in the future, because that creates a different vision. But you're also tying in a lot of people into your vision, and you have to adhere to all of their personalities and all of their ways, modes of working and modes of thinking, so that you can still go to an end goal. And if you become siloed, you'll end up probably failing because you have less of that open creative side. And yourself as a leader has to look at that leadership and say, can I take a little bit of all of this to build in this cauldron or pot to get to what we need is the right solution to then go forward and create that direction. So I think a lot of that comes from creativity. And if you lack the ability to dive into your own creativity, maybe you don't have that same opportunity to expand and grow a business at the scale, or to your earlier comment on this larger vision.
That's true. Plus, I think any human activity can and probably should be creative. It's like I've never ever once seen a business which could not become like art and science of business. And eventually, over time, you're not following books or, I don't know, university courses or, I don't know, some accelerator recommendations how to build a business. You take all your entire playbook and you choose pieces of it creatively up to a specific situation. And the more experience you have, more confidence you have that you actually know what you're doing, including like being able to say, well, actually, you know what's like there is this playbook, like, I don't know, appropriate in these markets. It's not applicable in those markets at all. Whatever everybody else is telling you, with like enough of experience and confidence in this art and science mix in business, you start seeing things very, very differently, and you're like completely not afraid to be alone in this opinion.
Agreed. Yeah, I think you're balancing somewhere the different facets of your skill set, right? By bringing in creativity, it allows you to shift the risk, but it also allows you to be more open minded. And I guess through that time, you'll balance out experience. Like the person you are today is not the person you were 10 years ago, and every year you only get stronger, better. Yeah, exactly. And I think that's the cool thing about entrepreneurship, or about yourself, is that if you continue to keep an open mind, you'll keep expanding, and the more at risk you take in other areas, say creativity and what you're doing with poetry, you're expanding what you can deliver, and you're trying to be unique and different. Imagine that you can carry that same unique and challenges and differences to what you do in everyday life, and challenge status quo, challenge the way something works, because your perspective changes every day with how much you challenge yourself creatively or financially, whatever it might be, right? So that's pretty amazing. And I think we could probably keep going on this trend because it's such an amazing topic. But I think what we wanted to dive into today, and I think we can go into a bit of background, but I think on your side, the key points of the background is that you're very fluid. You've operated across multiple countries, continents, and I think today, with the businesses that you're focusing on, it's been pretty cool because you're gradually shifting into more of this market on secondaries, getting more into M&A, and I think you're seeing such a huge upside value. And the way the markets are shifting at the moment, you're seeing that the stock market is at its peak. It's really skyrocketing and doing really well. So there's a lot of value that's in there. People are finding liquidity. But then on the other side, venture is down at its lowest numbers in 15 years. Everybody's been pulling back, and maybe they're shifting their money around to make some quick money and pull back. But eventually there's an opportunity right now, which is, M&A and equity investments, etc., that can really start to support this market again for its next run. And maybe that next run happens to occur during a recession, or maybe we circumvent the recession, who knows? But I'd love to learn a little bit more of how you see where the markets are sitting today. And maybe you can do kind of a snapshot of where you feel things are working globally, or maybe it's by continent. Maybe there's a bit of a shift everywhere. And then where do you see the opportunities? And then I want to dive into kind of some of the other aspects of the investing, from secondaries to fund to funds, and how you kind of see where the opportunities are in the next 12 months going after this early stage sector.
Yeah, 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 of course. So we are now focused on two things, right? One is mergers and acquisitions as growth strategy for emerging market startups in early stages. Speaking of creativity, we wrote the playbook on M&A for early stage teams. There are multiple M&A firms generally in the world which will say acqui-hire your startup or buy out your business for parts or something like that. We are doing nothing of the sort, and I believe there are not like maybe a handful of other funds which might be doing something like we do right now. And the idea is that in early stage, It's like, first of all, there is no reason to keep fundraising and keep raising venture capital at all costs, at all stages. There are other forms of growth. Last time we spoke about sustainable financial models. In the early days of, it was before the rate went up, basically. And we're talking that emerging markets cannot afford to be not sustainable, and that in high rate environments, nobody can afford not to be self sustainable. So investing to grow at all costs is gone, and big question mark for how long? Maybe for even 30 years. I mean, I wouldn't make any forecasts right now, and I'm a macroeconomist. But I don't think that we are going to see zero rate environments anytime soon. Or, like, if we will, then it will end up with even bigger financial disaster, because we already have very misplaced risks across the world, and it's been going on for 10 years. So this whole dislocation has to first be fixed before it can go to anything even remotely similar. The idea is that early stage is okay. You have just a few team members, you have something built, you have some revenue, you probably raised money, some bootstrapped. It's fine, like both work fine, but you've got a product which is working, and you're considering a raise to grow, like to invest in technology and products, maybe some licenses, expansion to new markets, and so on. And in high rate environments, pretty much other, like any other source of capital, is cheaper than debt and venture right now. And that's just base financial mathematics. On the other hand, you still need products and technology and access to new markets and STEAM talents and so on. And so instead of, say, trying to fundraise multiple times and then trying to execute, say, an acquisition when you're a Series C company, you can merge with similar sized, maybe a bit smaller, maybe a bit bigger startups, like in seed Series A stage. Considering that there are still few people on board, it doesn't take years for the merger. There is no need to fully merge technology as in the backend. Yes, you have time to do that, but you can simultaneously offer two different products which are comparable and synergic on multiple fronts, and cross exchange your clientele base, have access to multiple markets simultaneously, have immediate access to talents, and be closing the M&A deal in a matter of months, and finalizing the, like, all team merge, I'd say, in a month or two. It's like when you have like 10 people here and 10 people there, you don't need that much time to figure things out. It takes a bit longer in the beginning of the process to make sure that everybody is on the same page, strategic wise, culture wise, and there are multiple synergies across two businesses on the deal. But afterwards, it's much simpler and much faster, and so you're eventually getting triple business size once the deal is done in a couple of months after you've done it. And if you would compare it with, say, fundraising and investing your way through, it will take you a couple of years easily. So it's not even just cost of capital itself; it's also time. And the situation in venture right now is complicated for early stage teams, because the risks are still unbalanced in early stage. And it makes more sense for funds or LPs, family offices, angels to invest in post Series A than prior. Because post Series A, most of the companies already took the hit and priced the books appropriately. Pre-seed and seeds, especially in Western economies, are still overpriced. So, which is why the whole Series A right now is on full stop. Almost nobody is raising Series A except companies with insane revenues and track records, as in insane, not just generically used to be good enough for Series A. Oh, insane. Or founders with multiple exits, founders from, I don't know, YC, from PayPal, and so on. Like either it's this whole play of falling back to what we know in crisis kind of thing. So when investors saying COVID, everybody started saying, "Oh, we're open to all the new ideas, to cold calls, to discovery." Now everybody's, most of the market, at least in my view, is falling back to what they used to know and how it was done for years, as in warm introductions, are super confirmed multiple times founders, specific networks where you would fund pretty much anything because it's, I don't know, it's like Silicon Valley. But the capital in other places has dried up, and Series A is a problem in the United States. Like, imagine how bad it is in outside United States.
Now, that's a great summary of kind of where the markets are sitting, I guess, strategically, globally, on how they're looking at this early stage investing. And I think your description of where you break down and say, hey, look, we can go after M&A. This is a good way to grow. I guess I'll just start by, I'm going to rifle through some questions, but the first one that I would ask is, typically, how does the acquisition work if a company is going to acquire someone smaller, medium, or larger than themselves and merge that together? What does the financing come from that acquisition? Do they go to third party? Do they go to you? Like, where do you tend to see this opportunity to merge the companies in? Or do you fund the primary company with financing and then they go and do the acquisition? So you're taking a part of primary company one, doing it as an equity investment, and then they're using that funding to go and acquire their counterpart or the business that they feel is a good bolt on to their growth.
That's also a part of the playbook we're using. We are trying to do cashless transactions to preserve money for founders. As It's share swap transactions. In early stage, even if you can negotiate a deal, say Series A company buying out precedes company for technology and team, right? Say it's an acqui-hire, and the team is looking for some cash and shares. Like, it's still, if it's good tech and good team, and the idea is to actually grow a bigger business, not to cash out and leave, then you would still be looking into, I don't know, 5% cash out and 95% in share swap. Or it would be a full blown share swap, but the Series A team will take care of the pre seed team in terms of costs. So it will be a different way of spending money. Say team expansion, okay, like Series A company will be covering a bit more salaries and investing a bit more in marketing versus tech because they just bought a good tech they needed. And It's a different way of looking at things, and a different way of building the business growth. Our part is we're an M&A firm which works on the side of the company and doing the entire work, as in from research and finding potential companies to researching specific shortlisted companies to reaching out, seeing if like they think similar, and then putting everybody in the same room to see how they communicate, how they are actually aligned. Because it's like you can research a lot, actually, like really, really, really a lot beforehand. But until people start talking, you don't know really if it's going to be that good of a fit that you think it could be. So the first introductory conversations is really where it begins. And then it's all the way through negotiation, helping both companies to assess the strategic matches between product, technology, markets, go-to-market team, and so on. And negotiating valuations on both sides for a share ratio for the swap, and generally the deal structure itself. I don't think there is any kind of blanket term at all. The business valuations on merger and acquisition differ from venture. However, when you combine two companies, you end up with next level potential venture investment if the joint company decides to fundraise. So when you like go into the process, say two seed stage startups merging, both say 8 million valuation, both looking to raise Series A, and maybe they cannot, but most likely they will be looking, say, at 12 million valuation right now, tops, I guess. But if you say they merge at 6 million each, one on one, as in based on business valuation, not venture valuation. It's like some sort of like business value of different parts or a multiple if the revenue is good enough. It really depends which kind of type of which kind of assessment you choose for each company. And they really depends, as in like deep tech, software, revenue generation, enterprise. It would always be based on the case in front of you. But say you combine two startups through one-on-one share swap at 6 million with the venture valuations of 8. The joint company valuation most likely is going to be 15 plus or more, because you are combining two companies with revenue, with customer base, with expansion to different markets. So even the cross sell between the existing clientele bases within the markets they just like merged with together is going to create at least 30%, 20-30% of revenue in the next 6 months. So the outcome, even in the finance, is immediate. And the well, I mean, it implies that we're doing our job well as well, right? So we're looking for some really great synergies on multiple fronts, and like taking time to assess if teams can work well, if all these synergies are actually what we think they could be, that the teams are on the same page and everybody is willing to proceed. And then you have this, yeah, 1+1 is not 2 anymore effect. Plus a bigger business, you can start managing straight away.
Is there, in this process and timing of the way this works, when you're analyzing the business to getting into this acquisition to getting them in the room, is are you finding that your metrics are falling more on the startup that you're sponsoring? It's plugging a hole that they need more sales, or they need better finance, or they need a better tech stack. Like, are they coming to you with that ask, or is this more of you just have very similar business models, you're both wanting to grow, this is a great spot for both of you to be in, we think you two should get together? Like, is there um, other reasons that are driving this business to decide that they want to merge and grow that way? And then how do you manage two founders and their egos, if they do have egos, to support who becomes the prominent player in the business?
On finding matches, it's like a puzzle, cubic Rubik puzzle. You start with a strategic session with founders, basically. Like, guys, what do you want? What do you need? What do you have? What's your long-term vision for the business? What are options? What are the experiments you've placed before which worked out, but you can't really afford to invest in those directions? What's on your, say, technology and product roadmap, which you can develop, but you really don't have to? or which markets you would want to go to, but you really cannot afford to go to yet. And the time is now. And so you get these multifaceted assessments, and you start to getting ideas really quickly on like what's the potential target should look like, what would make sense to do. And for some, it could be even license acquisitions in fintech to open markets where the company is not present, because licenses take time. It's like you're essentially buying yourself 12 to 24 months by just acquiring licenses. If you have licenses and say early proven products but still developing, but the team which can sell, then you just bought yourself up to 2 years of time for not doing licenses yourself, plus money and it's like everything else which needs to be done, and the team capable in selling in those markets. So you don't need to hire, you don't need to train, you don't need to implement that many changes, and you already got into those markets. It's it's research, a good research, obviously. And then talking to teams, as in when we form the short list, we go on multiple calls with these teams without disclosing the company name we're representing. And we just talk, kind of like, okay, we know something about your company. First of all, we need to even check if it's real, because you can research a lot. This is very true. But sometimes some data is, I don't know, 3 months old, and in 3 months, company went through a huge pivot. So the numbers you have, they kind of relevant, but not really, because the business model is different, and so you have to reassess. And you also, but first of all, you're talking to people, so to understand their vision, their views, if they think M&A actually makes sense to them at all. And if they do, then yeah, we sign an NDA, we make introduction to the startup we represent, and take it from there, one step at a time. Like since we're an M&A firm, partner, advisor to the company, we try to take like 70-80% of all the work, so that founders, first of all, can concentrate on continuing building the business. And second, that we don't go into, I don't know, in-depth due diligence before it's very clear that the deal can happen at all. And like there are very many things you can cover in several conversations to get you a good understanding if it would worth the try. So every single step in our process is a reassessment on if it's a yes or no. So it's not like, oh, we found something, they had a great introductory call, it's full blown merger 2 months later. No. It's like every next conversation is reassessment of if it's still worth going. So we are like everybody is proceeding in good faith that we are trying to make it happen. But every single step is a potential walking away, not to waste time. And
Do you
there
have a
are
percentage?
elements you have to, like, you can pre-design, pre-set up. And so until you are getting into much heavier things, legal due diligence, like some maybe workshop between two teams on software sides, on product sides, you have to really think in terms of, is it worth doing? And it helps to like quickly stop communications where it doesn't make sense for any reason, actually. Because sometimes, yeah, it's alliance, yes, it's good, but the founders might have a different perception of their potential valuation, and the deal is like we can see earlier that the deal will be overpriced and would not be beneficial to the startup we're representing. And so we would say, how about we talk maybe in 6 months? We will continue what we're doing all the same. But maybe in 6 months later, we will be representing a company after the merger, which is bigger, and you guys would be able to find some, say, meaningful partnership. or any a joint venture in some market or something like that. But it's not worth the time to go through the process when you can see early that the deal will be not beneficial, not balanced out. Some founders just quite stubborn, as in they would start saying you from the first call that their latest valuation was 20 million, but when you start looking into the business, the reality is their best outcome valuation probably will be six. And so when the disparity is that big, you already know that you will never convince people that the deal is good, is interesting, the business is going to grow much, much faster because in their heads, they already say, well, we may be good for 18 million for the deal or 16 million or something, but not six, you know? And with our experience in this, there are a lot of things we can see much, much, much earlier. So there is no reason to stop in the process. Although, and there is no reason to lowball as well, because when we're trying to make this good match, we're looking into a joint company being also a venture backable startup, right? So the whole deal balance should be quite fair for both parts, for both teams. Because otherwise they will break down in a couple of years' time, and it probably will harm their both teams, both companies drastically. So we can't afford this kind of mistake as well. That concerns ego, by the way, because when, say, a founder on the first call starts saying that it's very important for them to keep CEO position or CTO position or whatever, it probably is not going to happen because, again, business is bigger than you are. If you're not interested in, say, you now own 50% of 10 million valuation business, and you don't think it's a good idea to own, say, 25% in 50 million business, then you're not really interested in building a business or a startup. And you don't really understand what you are doing except holding a large piece of shares in a company with some imaginary valuation, which has to become real, right? You like still have to sell somehow eventually to create this value on your cash balance out of this 50% of ownership. And the more we talk to founders, the more we realize that one of the first things we hear from mature founders is that they say exactly this. I understand this idea, I understand this strategy really well. I understand how fast it will help me build the business. I care about business being multiple times bigger, even if my ownership goes down. And ownership going down anyway in fundraising or M&A. In M&A, it goes down less, by the way, including that in the future you may not even need to fundraise ever again. But you still have to have some good balance and understand that if you want to build a bigger business, then of course you will have a role which would not be like for half of all the business processes. You will have to share, you will have to allow professionals and talented people in your team to take over.
Is there a percentage of companies that are just kicking tires? They're new, they're first time founders, and they just want to try and do this M&A thing. They're interested, but they don't really understand it. So they just kind of kick tires. And then you realize that they don't have the interest or the understanding, and they just want to get, say, interest or data points from the market. So they're doing it more of a competitive side than actually closing a deal. Or do you think everybody that comes into this M&A space literally has an interest to close a deal, buy someone or sell something that's in their business?
I think we've seen a few companies who were like, well, we can try to work with you, maybe even for research purpose, and we don't work. it's like it's working with that purpose basically. If you want to do research, you can do it on your own. You can hire an analyst actually. You can hire a venture analyst specifically to dig the data on all potential companies for synergies, and maybe even get to talk to them. You can do it on your own. You don't need us for that. When it's like, oh, I'm not sure, or I can take a look, but I don't know, we usually say, well, get back to us when you decide, because unless it's on purpose and has a reason, and you do think this strategy makes sense for you, we're just not a right fit. We will be wasting our time, you will be wasting your time. Our deal structure usually is shares swap, and we, as an M&A firm, are getting shares of a joint company once the deal is successful. So the last thing we're interested is wasting 6 months with no deal, because the majority of our deal structure is eventually shares of a joint company of successful deal. If there is no successful deal on the horizon, why would we spend our time, like basically invest in this whole process for that long, right? And you can, I mean, you know that, I'm sure, like over time with experience, you build visibility and you get to see enough people that you start to recognize, you know, if people are real, what the decision making process, what's their strategy, if they are hiding something from you, as in making, like, saying that they're working with you for the purpose, but in reality, they only want some research. You start to see it. I mean, it's really hard to not to catch the glimpse of that it's been like basically a fake transaction or a fake intent from the founder. Relatively quickly, we spend a lot of time with founders, and we discuss multiple different things around it. So at some point, it's just like you kind of start to see it.
It sounds like it's because it's a service, right? You're able to create benchmarks. You're able to create bumpers in the process so that you can work through that quicker, cut things off faster. You know, your time is valuable, and you want to make sure you're aligning up things in the right fashion. Do you have KPI or metrics that you look for? Like if you're sponsoring a Series A company, or they've raised the Series A, and now you're focusing on acquisitions. The acquisitions, do they have to have, say, a 100,000 EBITDA or $1 million EBITDA? Do they have to have some form of cash flow? Do they have to have two co-founders and three management? Like, do you have a minimum basis of what you need to have in the company? Maybe there's a revenue line that they have to have at least $1 million worth of revenue for you guys to actually look at this as being an opportunity, or is it strictly on, it's a tech company only, it's got to have tech, it has to have at least five people in the company? Like, do you create metrics so that you don't have to work with one man shows or one woman shows? Like, do you have those things to help you support the direction to make this process work smoother and quicker?
Not sponsoring, by the way. The company assigns us as an M&A firm, and then we represent the company in the entire process. The There are some metrics, as in, say, we're working with Series A company with 2 million in revenue, looking to merge, maybe acquire, more likely to merge, but something cheaper, as in seed stage company. And we need to make sure that they say have complementary business model and some specific market presence, right? So we need to make sure that first of all the attraction is meaningful, as in it's not $20,000 randomly, or a few contract signs manually. We need to understand that whatever, say, 500,000 interaction they have, it's technology driven, product driven, and it's fully supported by the team, though there are multiple things still to build, to explore, to figure out, and so on. They There are maybe some specific asks from the startup we represent. Say it has to have, I don't know, two founders and up to 50 team members, or up to 20 team members, like up to 10 team members, something. It's more of the cost of the joint team afterwards than anything else. There are often some ideas on, say, licenses or hardware stack or technology stack. So it's like compatible. So in the end, you would not have to rewrite the entire backend for two companies. So there are some things which would eventually be important, but metrics wise, it's something consistent with proven part of the product, and looking into a transaction with a smaller company, so that say revenue exchange would be 2 to 1 or 3 to 1 or something, so that founders of Series A company are not diluted that much. And a Series and seed company is okay to get in much higher dilution, but they're becoming a part of bigger business, because together they will be probably Series B to Series C straight after the deal is closed. So both win, and seed startup would not be negotiating much higher valuation anyway, because they're negotiating with Series A. So it's already like there is a leverage to that as well, but there is also a balance. For solo founders, it's an open question mark actually, because if they have a team, like fairly balanced with options and so on, it could be okay. There are some solo founders which are actually exceptional. Sometimes it's not even necessary to have anything but, say, solo founder plus team with options. But no family businesses, no, say, 100% full ownership, because it's too much risk. As in, you're acquiring a one man show, basically. That could be problematic.
No, that's great. And when you, I guess the last question to kind of wrap this up is that now this company that you're operating with, you've gone through metrics, KPIs, you've structured this, the deal's going to go forward, company merges together. How do you now look at secondary market? And can you explain just super quick, high level, what a secondary market is? And do you start to look at, let's start selling some of these shares so that we can make some liquidity or bring value? Are you doing that right away? Are you waiting 2, 3 years for that merged company to actually start to generate their new structured revenues? How do you start to look at that side of the market?
Oh, no, like this particular strategy, we are building larger companies through M&A. We take shares of a joint company into our portfolio, and we hold it and help founders build the business onwards till exit. It's like fully aligned with the prospect of the business, which is also kind of implies that we really need to be working with venture backable startups on both ends, and make sure that together they are still a venture backable startup which can grow. And venture backable, even if they would not raise again, or they will skip multiple rounds, still the trajectory of growth, so the upside, the value of the company, the value of shares would be growing much faster than generally just a business. So that's like one, that's what improved ventures does, right? Now, what Point Improved Ventures is doing, our joint partnership with the United States secondaries fund Point Capital, is something entirely different, have nothing to do with M&A, with companies we work with in our portfolio in Improve. In Point Improve joint venture, we are focusing on buying out portfolios of funds, ownership, piece of ownership, in between Series A to Series C, the sweet spot, which we think is on a higher risk curve to less, but almost all is either already at good valuation or going there, or in certain sectors like biotech is already there and very, very interesting. As we started off on the venture overview, venture right now is going through whole repricing and liquidation events. It's been going through it like actually since 2023. It's just 2023 was a whole year of doing nothing and waiting it out. And 2024, it started off with, okay, let's sell. Okay, we're okay with down rounds. We're okay with markdown on the books and so on. And 2024 was like essentially full blown first part of the process of liquidation, which I believe we're going to see in much higher levels this year. The last year there were what 15% less of all venture funds already. They just stopped working, liquidated, can't fundraise anymore, frozen. We're probably going to see a quarter, if not half of the industry, just stopping fully by the looks of it. Because, first of all, LPs are looking for liquidity. They are looking for funds to start generating actual DPI. Only what's 7% or something generated DPI in the last 10 years of all venture funds, which, if you think about it, it's just insane. I believe that a lot of LPs were also quite upset that in 2021, when it was possible to go for an IPO or an acquisition, many chose not to and blew up valuations even higher. So there was a window to make some cash outs, and almost nobody did it. And right now, the next window for any cash out for LPs is secondaries, one way or the other. Some mergers where it's potentially valid for late stage companies. I'm not a big believer in the IPO market opening up this year, but I do think that shares auctions, what's the right word for this? Employee tenders are going to provide much bigger liquidity. It's like kind of semi-private, semi-public version of IPO, which actually is good because liquidity is the turnover in secondaries and late stages is it's never been that high before. It's never been that normal to transact in secondaries generally. And now you can buy even Series A, which, if you remember, even 5 years ago, any investor would tell you if you see an investor or founder looking to cash out something at Series A, it means it's a bad business, it's a bad signal. Nobody thinks this way anymore. It's like there should be a reason. I mean, you wouldn't expect your angel investor or your co founder to sell, I don't know, 20%, you know? It's like we're not talking about insanity. But if a founder wants to cash out, I don't know, 0.5% to finally close their student loans, there is no problem with that. If there is a market for this Series A company and there are investors looking willing, including existing investors willing to buy it out, and the whole perception about secondaries has changed. And it's one of the biggest markets right now, actually providing the liquidity for parties.
Well, there's certainly a lot of reduced risk that comes out of that, and the company's older. It's grown a good space. The founder's more educated over time, experienced. So I think there's a lot of opportunities. We've had a few companies do that, and I think that it is changing the mindset that at any point in time you can shift where the risk is and allow people to have some form of liquidity to support their business. They're not going to spend 10 years living off 20K a year as a salary because they're trying to grow a company. So you do have to help the founders find balance so they don't create burnout and burn the company down. So there is a bit of a shift that's occurring. I think from there, I think we're going to shift a little bit into kind of the next stage. But by all means, if you have any last thoughts before we do, please share them.
I was going to mention one other thing is that so our M&A firm is Latin America, Southeast Asia, and Africa, and early stage talented founders in emerging markets, which always was our biggest bet. and always will be. In secondaries, it's I'd say an investment strategy. The betting on that there are multiple funds which do have a problem with raising their next fund, whose LPs are looking for liquidity. Maybe even general partners are looking for some liquidity, including to just simply reinvest money into the next funds, cover the costs of just managing the business, and so on. Have more money for follow up or investments if they need. It depends, right? But everybody needs cash right now. At the same time, Series A to Series C in major markets in United States, Canada, Europe, UK, Singapore, Hong Kong to some degree. Singapore, first of all, are went through the repricing process, at least in some industries. Say I wouldn't touch software SaaS with a long stick right now, but I definitely love deep tech right now because it's just incredible in these like sets, right? And when you start thinking about okay, which strategy would be reasonable to implement in these markets, it's proven large, more or less stable, so we're not taking country risk, unlike improved ventures in emerging markets, right? But we still want some diversification. So we don't want to buy in, say, a single stock. We are saying, let's buy out 10% of your entire funds, and it will be, say, 10 million SPV with, say, six, seven, eight investments in it in between Series A to Series C. And this SPV is going to be held till companies exit, or maybe we will come into the market as secondary sellers 3 years later when all of these companies will be definitely beyond Series C, and the market is liquid, so we can make a reasonable bet on that valuations went down in certain sectors in developed countries, that they are quite interested fundamentally. We are looking into companies with sustainable finance, with good revenues, with clear pathway on like what they're building, with clear access to data room, as in no secrecy play, no stealth companies, nothing of the sort. So companies we can actually analyze, understand, and make sure that yes, they're valid. We're getting some discounts because everybody's looking for liquidity, and plus, I mean, we're giving money today, not 5 years later. So that's in itself requires a discount, but that we're buying into a good asset at a reasonable valuation, and we're looking for a certain upside, but we're buying onto the sweet spot, which 3 to 5 years later will be either fully exited as a business, or we can exit part of it or all of it through secondaries like 2, 3, 4 years later. So we have this optionality, but very clear offer to investors, and very clear offer to LPs and GPs, as in, if you are willing to sell a small portion, I mean, you keep your, we're looking into good funds, not the fire sale, not the, oh, everything is so bad, we're willing to sell 100% of our funds. No, we're looking into great funds with great portfolios in probably hundreds, 200 million under management altogether. Because there are large secondary firms who are playing into like much larger funds. We would not be able to represent, I don't know, Sequoia, you know? It's like, like we have a realistic sweet spot in funds which we find interesting, and funds which we find attractive, where we have good network, and where the, say, our minimal check of 10 million would be 10%, not 100% of the fund itself, and where the upside is visible. So, as in, everybody wants some cash out, but they still want to keep their ownership. So we are like have this balancing act as well, and this I think this year is going to be even higher turnarounds on deals like this, because more and more funds, LPs, and GPs are coming to exactly the same conclusion.
I love it. So I think to kind of summarize our discussion today is to share that M&A is becoming a lot hotter market with the select groups that are like yourselves that are focused on high growth and high potential companies that are doing innovative um, expansion and looking at merging teams in that can enable and grow their bottom line, and that focused on secondaries as a future option to bring liquidity back to the investor, but also liquidity back to founders is a good um, step forward in the process that can help generate value for these companies to continue to grow and bring in and refresh the investors that are coming into a company early on and being able to exit and come back with new ones later on in the cycle and the process. And it sounds that as this market continues to expand today, there's a lot of opportunities with the right countries, the right thesis, and the right model that you can layer on and help grow these companies without having to go to pure investment. And you can do that through M&A, secondaries, debt financing. There are ways to support these companies without having to completely go to equity markets every time you're trying to make a company and support a company to grow. So I think maybe we'll leave it at that, Olga. I think we're going to have to jump back into another conversation, of course. But I think that this was a great overview of how M&A works and where it sits in the markets today. And it sounds like a very exciting space, and things are moving quite quickly. And the way we like to kind of end our show is that we want to give you the opportunity to share anything back to startups, to investors, anything that you want to say, and please share how people can get a hold of you at the same time.
Yeah, for sure. We have two areas we are focused on right now: mergers and acquisitions for early stage teams in emerging markets, and secondary buyout from funds in developed countries in growth stage. We, I mean, LinkedIn, email, websites, like everything is available, obviously. And we are happy to talk to LPs looking for some secondary sale and GPs. Happy to talk to founders in our respective markets on M&A. And I'm Jeffrey, you know that. Everybody else, be warned that I'm very straightforward. I don't ever shy away from questions. So it's like anything you want to ask, you can always reach out and ask. I will always respond. Probably send you materials and links to read and workshops and like God knows what else, because we have. Fair ideas, but also have methodology and documentation and structures and God knows what else, as like every other well fine defined business. And Last time I read a lecture on secondaries, it's a workshop. It was a workshop, and that's I spent a couple of hours just walking investors through all the opportunities, ideas, investment strategies, optionality, and discussing certain cases on say what is say there are some companies which are technically late stage venture, but they're not. In reality, the whole bets on investing in them is not venture at all, and so on. So there are many tricky things in this space. Same in M&A. So
I love it. Well, Olga, we appreciate all your time. You're a rock star, and you're doing a lot of great things. And we're excited to continue to follow your journey. And we're glad that you came back to share. And we wish you a fantastic week ahead. But thank you very much for sharing today.
thank you for having me again. Have a fantastic day, Jeffrey.
Thank you. You too.